What's up, guys? Hopefully you guys are having a amazing day. Today we're going to be basically talking about why you keep losing in the markets. And so this is the big question that you guys are probably asking yourselves, why do I keep repeatedly losing day after day, trade after trade, week after week, month after month? And you might not be losing every trade, but your account is slowly decreasing in its value, and you're wondering why it keeps doing that steadily when you're trying to gain its value consistently forward, but it keeps decreasing. You're probably wondering why, and it seems so elusive and like it's so like close, and you're so close to finding out what it is, and just or maybe you're not sure. But this video will break down in methodology terms why you keep losing day after day. We'll be talking about the AM session, the London session. So if you trade either or, I got you. And we have in-chart examples for just price action that is a bit lower probability, and just something you don't want to partake in. And so first off, we have the AM session. So the AM session starts from 9:30 to 11. So if you guys trade this session, this would be quite valuable for you guys. So definitely take a look. So for the AM filter, the first thing we have is we already have a large range the previous day. So in this case, if the last day was bigger than the last previous 3 days, then you want to kind of like either skip the AM session or wait till 10 a.m. But if you're new, I would just suggest just skip the whole thing and wait for the PM session that starts at 1:30. That's what I would do here. So for an example, I guess I'll show you an example in the charts really quick, like why not? So for example, it would be like this day. Perfect. This day right here. Last 3 days prior to this day. Let's say we're like want to trade this day. You look back at this day. Okay, I'm not trading the morning session. Look at these 3 days prior to the big day here. Don't want to trade the next day, the next AM session on the next day, right, guys? Same as I guess this, but it's not really. Be more something like this. 3 small days, 1 massive candle. Don't trade this morning. And I guess this one too. 3 small days, massive candle. Don't trade this morning. This one too. 3 small candles, 1 massive candle. Don't trade this morning. That's pretty much it. It's super simple. Let's move on to the next one. Again, if you guys have any questions, just comment down below and I got you guys. If the opening range gap is less than 40 pips, wait until 10 a.m. So the opening range gap is, let me just mark that out for you guys. I'll just give you guys one example. It's so simple. Just write these down, these times down in your notes, because it'll be quite important for the opening range gap. So what you do is go to the previous day at 4:14. Mark out the close on that day, 4:14 p.m. Close right there. There we go. Go to the next day, Wednesday at 9:30. Right here, perfect example. At 30, and take out your measuring tool. And measure the difference, which is 21 points. And so go back. I said if it's less than 40 points, then you wouldn't trade till 10 a.m. So you wouldn't, in that case, you wouldn't trade till 10 a.m. But usually you'll want to trade if it is above 40 points. Let's go to the next here. Do we have a very large opening range on Sunday? Skip Monday's AM session. So opening range on Sunday would be the new weekly opening gap. So for example, let's go here on the weekly chart. This would be a small opening gap. This would be a big one. So we closed here, opened here on the next week, and you wouldn't trade the AM session on that Monday morning. If we had a larger than 110 pips range overnight, 2 a.m. to 5 a.m., which is the London session, wait until 10 a.m. So we'll go check that out really quick. Go on the 15 minutes, super clean. So you have 2 a.m. that starts right here. Something like this. 56. So this day would be good. You just measure out the range from 2 a.m. to 5 a.m. and determine if it's below 110 pips. And if it is, you're good to trade the AM session or trade before 10 a.m. Next up, is it the day ahead of a holiday or a long weekend? So if there's a long weekend or a holiday, just don't trade on that Monday or Tuesday if the holiday's on Monday. I know it says lower risk here, but I would just say if you're new, just don't trade. If you're more experienced, then lower your risk. Next up, for the AM filter, we have is the day after a long weekend or holiday. So okay, so this one's ahead. This one's after. I just filled in the blank there. So yeah, ahead or after. Don't trade. It's low probability. It's gonna be super slow. Just a bunch of consolidation that they're gonna hold. Yeah, they're just gonna hold price and absolutely demolish you the next day. So next thing we have is the London filter. So first thing, if you trade London from 2 a.m. to 5 a.m., this is for you. So after a series of 3 consecutive up close candles, avoid longs. So if you go here on the daily, if you see 3 up closed, so 1, 2, 3, avoid going long, and down close 1, 2, 3, avoid going short. See 1, 2, 3, and went down. 1, 2, 3, kind of indecision, and then went down. I mean, here it just kept going down, but sometimes it's just gonna be like that 1, 2, 3, bearish day, kind of thing like that. It's super simple framework. I think it's just down close, avoid shorts. Same thing I would explain to you. Next thing, don't trade after FOMC whipsaw. So if there's FOMC news and it just takes out multiple sides of the market and just creates super big candlesticks, then don't trade the London session. Next up, we have don't trade ahead of NFP. That's super simple. NFP is once every month, and don't trade before that news. So it doesn't mean don't trade on Monday or Tuesday. It just means don't trade on Wednesday, Thursday, Friday. Don't trade the day ahead of a weekend or holiday. Same thing as the AM session. Don't trade when the markets don't trade when the market starts a sustained rally or decline after 8 p.m. Yeah, so guys, if you go on your charts, 8 p.m. is pretty much Asia session. If there's a sustained decline or rally, that means that is the hype train. It isn't. Everyone's in the market basically. So the next thing that they're going to do is chop the market up and down, and that what is next is the London session. So you don't want to be trading in that. So Asia session already delivered. You don't want to be trading the London if the Asia session already delivered to the target. That's super simple. Easy rules to follow, guys. Do we have a large range day? Then it's the same as the AM session, just don't trade. Yeah, we have in chart examples now. So if we stay in P race for long periods of time and we keep revisiting them. So next up we have if the Nas, we kind of pretty much already went over this. This one's just a bit more descriptive. So this one's like if it's below 75 pips instead of the other one where it's 40. This one's 75. Expect some possible chop, so it's maybe either or. It's kind of like a 50-50. But if it's below 40, expect a chop. When you're in a congestion or a bunch of new day opening gaps, new weekly opening gaps, the market will have the tendency to or urge to consolidate. So quickly, I'll show you. That's super simple. Just go on the daily and look. Check this out. So as you can see, there's a kind of like a swing move here. Absolute right through it, came back into it, and well, we had to deal with all of these gaps here and these inefficiencies. Once we got out of it and started reaching this area where it's more smooth, then we went for the highs. But like that, if you see how it's like a bit like lathered back and forth here, it kind of messed up the market going forward because there's a bunch of gaps here, 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 here. Notice a bunch everywhere. So yeah, it made the market chop back and forth. Next up, we have are the characteristics of we run deeper retracements than you'd expect. So yeah, if you get deeper retracements, no. So if basically if you want to determine the characteristics of the market and determine if it's a high resistance liquidity run day, you would look for deeper retracements than you'd want to see. So if you see that on the chart, then you would take a step back or lower your risk. Super simple. Next up, we got if the S&P and Nas are decoupled. So what we mean by decoupled is, I'm not going to pull up the S&P 500 on here, but it's so simple. So let's say this portion on the chart here is clearly going up, right? If this portion of the chart for the S&P 500 was going down, that's what it means decoupled, because these markets are supposed to be somewhat in sync. But if they're not and they're decoupled and the S&P 500 would be going down, then you would not look to trade. It would be a low probability condition. Last up, we have all-time highs. So ever since we've been at all-time highs, it's been kind of a train wreck, and I've had like in 2 weeks I've had like 3 trades, and yes, they were good trades, but 3 trades in 2 weeks is a bit ridiculous. Like that's pretty low. In the past like 4 or 5 weeks, in the past like month, I've had like 6 trades. I ended up going to swing trading because if you guys saw my last video, because I'm not getting very much trades right now since we're like in all-time highs, and it's just hurting myself a little bit financially, but we're definitely getting there, you know. But yeah, that's pretty much it for this video, guys. Like I was just going over how to not hurt yourself too much in the markets when the probabilities are low, and to save your money kind of thing, and mitigate your risk, and just take trades in high probability conditions so this doesn't happen to, or you don't say this, you know what I'm saying? So that's pretty much what I went over. Like I said, guys, if you guys saw my previous videos, I'm starting a Discord channel, so if you guys are fond of that, definitely check out the link in the description, and yeah, meet me over there, check it out. Awesome community, and yeah, have a blast, guys. Have a good day. Peace.